Welcome to the adjustments phase of our tax filing. Adjustments to income is what happens when a person's taxable income can be adjusted based on certain scenarios. This all goes towards calculating someone's refund. When it comes to adjustments, VITA TCA wants volunteers to pay careful attention to what is in scope or out of scope for filing. Today, we will work on calculating and accurately reporting adjustments to income. You will be reviewing tab E in 4012, which is the section on adjustments. Educator expenses, self-employment tax, penalties for early withdrawal, alimony paid, IRA deductions, student loan interest, and jury duty pay are all topics that are in scope for VITA volunteers. These items should be clarified on the 13614C intake sheet that the taxpayer has previously filled out. If anything on that sheet is still unclear at this point, you will need to contact the taxpayer. These items will be listed on the 1040 only under the line that reads Adjustment to Income. You will go to Schedule 1 for details of the adjustments. Educator expenses is a great adjustment for teachers to take advantage of. Kindergarten through 12th grade teachers can deduct up to $300 in qualified expenses if they worked at least 900 hours during the school year. This includes books, supplies, and other materials. School crossing guards, janitors, and cafeteria workers are not eligible for this adjustment. If married filing jointly and both taxpayers are teachers, they can adjust up to $600. Professional development expenses related to the instructor's course curriculum are adjustable. Homeschooling expenses and non-athletic supplies for courses in health or physical education do not qualify. The taxpayer cannot claim the deduction if he or she was reimbursed. Reimbursement from their employer may or may not be listed on their W-2. If a married filing jointly return and both are teachers, simply qualify each spouse separately and determine eligible expenses separately to determine the adjustment for each spouse. Publication 4012, page E8, outlines the educator expenses in Q&A format. TaxSlayer will automatically add the educator expense back into California adjusted gross income. Self-employed taxpayers are people who file a Schedule C to report their business income. We went over this in our income section. The people who have reported business income will likely get a break by the self-employment tax adjustment. These taxpayers are also responsible for paying self-employment tax. They are eligible to take half the self-employment tax as an income adjustment. Be careful with Form 1099 MISC if the form is not reporting self-employment. Be sure to check each 1099 INT for the box labeled Early Withdrawal Penalty because the dollars can be taken as an adjustment to income on the tax return. The penalty is subtracted from total income. Penalties are assessed when funds are withdrawn from a deferred interest account before maturity. You may see penalties for early withdrawal on a Form 1099 OID as well. Taxpayers may report an early withdrawal penalty without a form. That is entered using deductions, adjustments, penalty on early withdrawal of savings or CD in TaxSlayer. Alimony is income for the spouse receiving it and an adjustment to income for the spouse paying it. That is, of course, if the divorce was executed before December 31st, 2018, or modified before that date. Starting December 31st, 2018, alimony is no longer reportable federally for either the payer or the recipient. So you'll have to ask questions and make sure that the dates are clarified. If it is reportable, you will need the Social Security number of the recipient, date of the divorce or separation agreement, and amount paid. The IRS wants to make sure that the recipient reports the alimony received as income. Divorce agreements prior to 1985 are out of scope. A special note regarding California alimony paid and received. California does not conform with the federal change that made alimony after December 31st, 2018 non-reportable. There are spaces for up to 3 names for the people who you pay alimony to. Social Security number is not required. Adjustments to income is where you handle IRA contributions. Only traditional IRA contributions are deductible. Roth or SEP Simple IRAs are not eligible as an adjustment to income. As a side note, SEP Simple IRAs are out of scope. You cannot write these deposits off, however, traditional IRAs are eligible. The taxpayer may have options until the Retirement Savings Contributions credit, but that will be covered under the Miscellaneous Credits module. These are the maximum contributions amount annually, and they cannot be more than the taxpayer's yearly income. This adjustment is subject to income levels and so may be reduced or eliminated depending on income, filing status, and if the taxpayer is covered by an employer retirement plan. All of these things affect the adjustment. Other issues arise if the taxpayer has excess IRA contributions. An excess contribution is the smaller of the taxable compensation for the year or general limit amount. Non-working spouses can contribute to their own IRA up to the limit shown here if their working spouse is covered by a retirement plan. If you enter IRA contributions greater than compensation or in excess of the table, TaxSlayer will lower the amount of the deductions but not tell you that it did. So, if your taxpayer made the excess contributions, they won't get the benefit of the adjustment. Contributions to the 2024 tax return can be made up until April 15th, 2025. It is common for a taxpayer to decide to contribute to their IRA as you are doing their taxes. If this is the case, you can enter the amount that they say they are going to contribute before the deadline and make them swear on a stack of Bibles that they will make the contribution. Failure to do so will result in a letter from the IRS with an adjustment in their refund or increase in the amount due. Student loan interest paid could be taken as an income adjustment. The amount is either $2,500 or if less was paid, the lesser amount. This adjustment is also phased out or eliminated based on filing status and income. For single filing status, the adjustment starts phasing out at $65,000. For married filing jointly, the adjustment starts decreasing at $135,000. The taxpayer cannot be claimed as a dependent on someone else's return, but may be eligible if paying student loan interest for a dependent. It's important to understand the taxpayer's situation in this case. Note that student loan interest adjustments are interest only, not a paydown of the principal. Principal is the amount that a student has borrowed, while interest is what they pay as an agreement of their loan over time. The Secure Act of 2019 allows for a distribution from a Section 529 plan of up to $10,000 to be applied to a qualified student loan. The more you work with these deductions, the more comfortable you will get with where to find the information in TaxSlayer. The most important thing to remember is that these 6 areas of adjustment are in scope, and so long as the information in intake is clear and you are doing your due diligence, we should be able to adjust the taxpayer's gross income appropriately. The following items are out of scope. If there is a Form 8606 required for non-deductible IRAs, we are unable to prepare that return. If you see that form, please let the taxpayer know that they will need a professional tax preparer.